This is Colin Cattell with Palisade Radio. On the show today, we have a new guest, Eric Coffin. He's known as the hard rock analyst. He's been around in the space for quite some time. Eric, thank you for joining us on the show today.
Thanks for inviting me, Colin.
It's certainly not easy being in the hard rock space right now. It's been a very difficult time. What are you looking at in the space these days? Have you kind of just shut off, or are you looking for a certain catalyst for things to turn around?
Yeah, I mean, I haven't shut off, but I do recognize that, as we all do, that we're in a market right now where it's going to take something fairly major to get traders to care about things right now. We've got some very contradictory signals in the market right now. Because of that, and because I've had some concerns about Asia, I have stuck a little bit more to precious metals and base metals, and I'm trying to put together a mix of sort of, I guess, two types of companies. One is one where there's an obvious catalyst that would allow for a re-rating. There's several companies that on the list that I'm following closely because I'm expecting them to go through the next stage of economic analysis, like going from PEA to feasibility or nothing to PEA, or from that to a mining license. There's several on the list like that. At the same time, particularly at the alert level, I have this running list of what I call Hail Mary companies that are essentially ones where I'm putting them up on watch lists, but I'm watching for specific exploration results. As now, it's not very active out there, so there's a relatively small list of companies that are doing significant exploration programs. But I'm still of the opinion that someone that makes a new discovery that's clearly economic is going to get some love for it. So that those two areas, guys moving to the next stage and becoming potential takeover targets and discovery companies, are sort of the two areas where I'm focused. But I haven't added a lot of companies in the last year because there's just not that many guys doing things significant. I'll be adding a couple in the next couple of issues, but I haven't added many lately.
Well, Eric, I don't think you're alone in saying that there needs to be some type of catalyst for commodities to start moving back up in the right direction here. Have you identified what you think that catalyst might be? I know you've written about interest rate hikes and about the devaluation in the Chinese yuan that just happened.
Yeah, I mean, I'm China. I think the jury's still out there. I'm probably, unlike just about everybody, it seems, especially in the U.S. I mean, I'm of the opinion that if China really goes free market with their currency, I honestly think the odds are higher of it dropping than rising. That's obviously going to have some repercussions in terms of exported deflation. But I also think they're loosening the band on the yuan and moving more towards a market-based currency. It's something they'd always planned to do. I think their hand was maybe forced a little bit by the IMF refusing to include the yuan in the special drawing rights, which obviously the guys in Beijing aren't happy about. I don't really blame them. But I think the move was afoot a long time ago anyway. And for me, I don't think the end game for Beijing in doing this is just to loosen the currency. I think they're doing it to allow currency flows that'll make it easier for them to move rates down. Because if you look at their internal inflation rate and you look at their interest rates, China actually has quite high interest rates compared to the other G8 countries. I mean, they're very high, actually. There's definitely room for them to move rates down a couple of percent. The problem in China, though, is freeing up the liquidity and not having all that liquidity flow to a bunch of bloated state-owned enterprises that are probably just going to waste it on white elephants. That's not a problem they figured out how to deal with yet, but I think if you look at the last 20 years, it's fair to say that the guys in Beijing are reasonably good economic managers. And I think when it comes to base metals in particular, the real story in the next 6 to 9 months is, can China find a way to pull out of this dive and generate some growth? There's been rumors floating around for a few days now that we're going to see another big infrastructure program announced. I don't know whether that's true. It doesn't really fit with what they've been doing lately. But if that's what they do, because it's an easy and obvious thing for them to do, I think that's going to help base metals quite a bit. And in that space, you got to differentiate between metals that have a fairly good supply-demand balance, or at least have producers that are willing to react fast to negative market information. I would include copper in that, because I think copper producers have always been better than a lot of the other miners when it comes to adjusting their production, and I don't think the surplus is particularly large right now. I still like zinc, partially because there's some big producers coming offline at the end of this year, and because I do think China is quite serious in their push to deal with their horrendous pollution problem. And part of that solution is going to be cracking down harder than they even have already with a lot of the smaller kind of mom and pop quasi-illegal mining operations in China, because China does actually have a lot of zinc. And on the precious metal side, I think that the top on the dollar may well come when they start raising rates. It's been a truism on Wall Street for 3 years now that the Fed's going to raise rates, and when that happens, the U.S. dollar is just going to go up and up and up. I pointed out in the newsletter a few months back that if you look at the last 4 tightening cycles, the peak for the U.S. dollar was actually right at the start of the tightening cycle. And I've got no reason to think that's not going to happen a 5th time. And I don't think that's priced into the market. It's certainly not priced into the gold market. So I'm hoping that a combination of scary equity markets in New York and the Fed maybe finally pulling the trigger, that may be what finally puts the bottom in for gold. And then, because I think if we've got any positive momentum on the gold side, there's a lot of room for producers and developers to make price gains, because it's arguably the most beaten up, underloved sector in the entire market.
Very interesting. How are you breaking up your portfolio? A lot of people are sticking mainly with precious metals because there is so much uncertainty. You just touched on that. And precious metals should react positively to a lot of bad things that would happen in the world. On the other hand, bad things like economy shrinking or China starting to grow less fast would negatively affect the base metals. They're already down tremendously, of course. But how do you go between precious metals and base metals? What kind of split do you happen to look for?
I mainly, in my mind, there's always sort of two products to the mining sector. One's pro-cyclical, if you want to call it that, which would be, all of the base metals. And even something like diamonds, for instance, where really, money that gets spent on diamond, you're talking about discretionary spending. So really, diamond prices are going to strengthen and weaken with the overall economy. When the economy's doing crappy, people don't go out looking to buy gemstones. Gold has more of a counter-cyclical thing. It does have the advantage, and it's a large advantage that tends to be underappreciated, especially these days. It's one of the very few asset classes that's not actually correlated very well at all to equities. Virtually everything else is. Like when the ship goes down, all the rats go with it. And gold's one of the few things that tends to at least perform less badly, if you want to put it that way, than everything else if there's a big market pullback. Because I do tend to like to play in the explorers, and because gold exploration stocks tend to get better leverage than base metal ones to discoveries, I would say I'm probably weighted a little more on the gold side. That said, I do have a couple on the base metal side. Like I've got a producer, Sun. It's just a great producer. They make money every quarter, lots of it. Most of their share price right now is backed up literally by cash in the bank, and they just keep spitting out more money. It does move with the copper price, so you've got to be realistic about that. It's something that you want to get on weakness when copper's having a terrible week. But it's to the extent you can call any mining stock a safe stock, it's a relatively safe one. They also have a nice dividend. On the development level, I like Excelsior as a copper developer because I think the ISR process that they want to use in Arizona is going to work. I mean, there's a timeline for sure in terms of permitting, but it's sort of bottom of the cost structure. So I like that one. And on the gold side, I'm similar. That the things that I like that I'm following at a development level are ones that, if they live up to their billing and their feasibility studies, will be low cost producers. I mean, companies like True Gold, I like Rock. I love Rock Gold because it's so high grade, and I'm a big fan of grade. It's not just a matter of the gold prices have been weak. And generally speaking, the biggest advantage to a high grade deposit is when you get these weak periods, especially if you're dealing with an underground deposit, you can adjust your grade. You don't necessarily want to. You don't want to be high grade, but you at least have the ability to do it. If you're a big, giant, 250,000 ton a day open pit mine, and your cutoff is $1,200 an ounce, and the gold price goes to $1,100, you're screwed. The old saying in the mining business is you can't stope an open pit. So I tend to favor grade over sheer size. I mean, I've got no problem with huge deposits, but I've got to think that it makes sense economically. I've never been a big fan of saying look for stuff that's super marginal and then hope the price goes up. I'd rather look for things that look like they make sense at whatever the prevailing price is.
And I'm interested in your Hail Mary watch list. Just what kind of criteria are you looking for? Some of these companies have tremendous amount of leverage. A lot of the companies you just talked about are, in my opinion, high quality companies. They have either great assets or they are producing, but certainly you're looking at some earlier stage things or some more speculative ventures. What kind of stuff makes it on that watch list?
I mean, most of the ones on the Hail Mary list right now, and this is really what I use it for at the alert level. I mean, they're essentially they're drill specs. They're companies that are doing, by today's standards, reasonably large drill programs, say 5,000-10,000 meters plus. So, which to me hopefully means there's going to be not one news release, but several news releases. And I look for companies that are drilling targets that I either think have big scale potential or ideally have scale and grade potential. The kind of things that can generate those drill holes to get attention even in a bad market. And the reason why they're on that list, if we were in a raging bull market, a bunch of these companies would have probably already shown up in the journal. But right now, because we're in a market where you rarely see much anticipatory buying, I don't feel the need to sort of officially start coverage until I see a couple of drill holes myself. But I do like to get them out to readers so they can be on their watch list and they can be keeping an eye on them. And if they've got a portfolio set up like I do, where you're going to get notifications, they can add the company's name, and when a news release shows up on drill results, they see it right away. And because I've already kind of walked through, this is what I'm looking for, and this is what a good set of results would look like to me. It also allows me to jump on it pretty fast once the drill results come out. But right now, they're mainly gold explorers. There's a couple in the Yukon, there's a couple in Nevada, there's a couple in other places where it's really going to depend on what the results look like. There's ones that look. There's other companies that are doing exploration where I can see they're getting traders' attention, but in this market, getting traders is great, but you really got to deliver a couple of drill holes to be able to make the thing last and really have the upside.
Eric, thank you for coming on the show. It's certainly one of the worst times we've had in a long while for the mining sector, but based on the catalysts that you're looking for with the interest rate hikes, we could be right around the corner from things finally turning around. It seems impossible and so far away when you're at the bottom of the market, but hopefully we're getting near. Your website there is hraadvisory.com. Eric Coffin, everyone, thanks for joining us.
Thanks very much, Colin. Nice talking to you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?